Is the Fed finally done, and are we on our way to a recession? Well, as quickly as predictions were made, predictions were reversed, and half a dozen banks have all changed their tune, saying that the Fed is done raising rates and that we're going to see the Fed start dropping the Fed rate as early as Q1 or Q2 of 2024. Now, meanwhile, Fed Chair Powell will say they're not even thinking or talking about lowering the Fed rate, but the market says otherwise. But before we get too far, if you like content like this, make sure to subscribe to our channel and hit the thumbs up. It allows our content to reach more listeners like you. So while banks are saying that we're going to start seeing Fed rate decreases, really the only way this can happen is if we do enter into a recession. Now, the last GDP print was 4.9%. Now, remember, average is like 3. So that's a massively strong economy. But when you dive into it, although we saw good consumer spending, we saw weak business reinvestments. That's important going into this next quarter. Now, on the heels of a stronger GDP, we saw other leading indicators that clearly show that the economy is slowing. We saw unemployment jump from 3.8 to 3.9%. Now, remember, the last 12-month low was 3.4%. If we see a 3-month average of unemployment above or at 3.9% per the SOM rule, we are in a recession. We also saw the core CPI, the Consumer Price Index for inflation, drop to a 2-year low of 4%. This is lower than the expected 4.1%. We also saw the headline CPI drop from 3.7 to 3.2%. On the heels of CPI came out the PPI report, or the Producer's Price Index, which typically looks at the wholesale price of goods. And that dropped, the largest drop that we've seen since April 2020, a full 0.5%. Retail sales also dropped 0.1%. Now, it wasn't quite as big of a drop as expected, but still showing that consumers are spending less at the retail stores. And the final indicator was the initial jobless claims, as they jumped to a 3-month high to 231,000. Given a weakness in retail sales and inflation coming down and unemployment ticking up, we are seeing a slower economy, despite what GDP report comes out saying. Well, given all of this, the market celebrated. We saw the 10-year Treasury dropping from 5% to under 4.5%. And given that, interest rates dropped to their lowest that we've seen since September. Mortgage purchase application did what it does. It celebrated coming up to its highest in 5 weeks. And affordability got just a little bit better, even though it's still at a 39-year low. I want to celebrate as big as the markets did, but I also don't want to get too optimistic. We know that retail sales going into the holidays is going to pick back up again. We also know, due to comparisons from a year ago, that inflation is going to get a little sticky. So while that means that we have more volatility in front of us, we also know that 6 of the largest banks have come out revising their expectations for a better 2024. NER's economist Lawrence Yun also came out expecting interest rates to be below 7% and existing home sales to increase by 15% in 2024. He also stated he expects to see new home sales increase by 19%. With improving predictions for 2024 and expected demand to increase with still limited inventory, we all know what's coming next. I don't have to repeat it, you know it, that we're going to see increased demand push up home prices. We're going to look back on the fourth quarter of 2023 thinking that was the best time to buy. We already saw that as the weekend leading into Thanksgiving week, with rates dropping more than 0.5%, demand came out and contracts were won. Given all of that, my question remains this: when is the right time for you to buy? And if the right time for you is now, this fourth quarter is giving us the opportunity for increased negotiations, given that sellers need to sell, slightly lower interest rates, given interest rates drop more than 0.5%, and the benefit of looking forward towards refinancing and increased appreciation. And remember, as things keep changing, if you want to continue to get updates on the housing and economic markets, make sure to not only subscribe to the channel, but hit that thumbs up and comment down below.